I'm at Research Market Insights video for August 10th, 2023. Everybody, Willie Delwich here. Glad you have tuned in. It is Thursday, so it's time for our 3 for Thursday video update. And I want to think about this in context of some of the volatility that we've seen over the last week, this week, every day this week so far. For example, we've seen more new lows than new highs. If you look at the NYSE plus NASDAQ, that's continuing today. We've seen examples across over the course of the trading day, early strength leading to later weakness. So the question really is this just seasonal volatility? Is this a welcome respite after a really strong start to this year, or is it the beginning of something more serious? And so the focus for today, while it's 3 different topics, it kind of fits into this idea of the good, the bad, the ugly in terms of what we're seeing beneath the surface away from some of just the price action, trying to answer that question of, is this August volatility just a pause that refreshes itself or the beginning of something more dramatic? And so as we go through the video today, the good, that's earnings revisions, they continue to move higher. The bad, not only are we seeing deteriorating breadth, but we're seeing investors start to head to the exits. We'll take a look at the latest survey data. And then the ugly, we had inflation data this week. Depending on which way you want to look at it, depending on which way you feel comfortable looking at it, looks great, looks awful, looks somewhere in between. So we'll put that in the ugly bucket. We'll explain as we go forward. So we'll start with the good. That's the earnings revision trend. Top line here, that's the S&P 500. The bottom is earnings revision trend for mid caps. It's a similar story if you look at it for the overall market for the S&P 1500. I'm using the mid caps here for a couple of reasons. One, mid caps have been a source of strength, so I'm paying attention to them. And then two, we're seeing a more significant breakout there. So I just want to highlight that. And just to clarify, this isn't the S&P 500, this is the S&P 400. So we're comparing apples to apples on this chart. So S&P 400 up here, earnings revision trend for the S&P 400 down below, and it's not rolling over, it's actually rolling higher. It's breaking out to its highest level in over a year. So at a time when we're hearing about the risk to earnings is to the downside, what we're actually seeing is earnings revisions being revised higher. Let's zoom away from every day's movement here and movement there. The basic idea that we want to focus on here is, if the earnings revision trend is moving higher, it means that analysts are having to take their estimates higher than they were. The market's surprising to the upside. Price tends to follow that. And so the big damage, big extended moves lower tend to happen when the surprises are to the downside, not to the upside. So earnings revision trend heading higher, that suggests that the volatility that we're seeing this month is just a pause, not the beginning of something more dramatic. The bad, that's when we start to think about price and sentiment together. We mentioned a couple of weeks ago that from a sentiment perspective, we want to go with the crowd until it gets to an extreme and then reverses. So as we're seeing more and more optimism, that's not an issue typically until the crowd starts to reverse. That now is what we're seeing. We saw a hint of it last week in the NAIM data that dropped from 100 down to below 80. That continued this week down to 65. So it's kind of broken this cycle of higher highs and higher lows. That seems to be significant at this point. And it's being confirmed more minorly, but directionally getting confirmation from the II bull bear spread and the AI bull bear spread. Both they are starting to roll over. Keep in mind the Investors Intelligence bull bear spread was at its highest level since mid 2021. The AI data, remember that was the laggard for so long. That had actually soared to its highest level since early 2021. Meanwhile, the NAIM data, that was just at its highest level since late 2021. Either way, regardless of the thresholds that were reached, all 3 of these reached excessive optimism. All 3 now seem to be reflecting that rotation away from that. So the crowd is starting to reverse. As the crowd reverses, especially if we're getting weak data beneath the surface in terms of the the new highs and new lows, that adds to downside risk for the S&P 500. Um, given the gains we've seen so far this year, it's going to take a little bit of price action for this to look significant on the chart. But at this point, the shift in sentiment suggests that might be something we could see. Again, time will tell whether or not it's the earnings revision trend that we should be paying attention to or sentiment, but they're arguing for two different outcomes at this point. And then the ugly, that's the CPI data. Um, Whether you're looking at the headline or looking at core, I believe in even the median on a month over month basis, we're all up about 0.2% in July. But when we look at what's happened over the past year, that gives us a different picture. And I will tell you, people will focus on these depending on what their desire or argument is, what their narrative is with respect to inflation and with respect to the Fed. I have long been a proponent of looking at the median CPI and the median PCE. A big reason for that, this quote here at the bottom. This is directly from the Cleveland Fed's website. In fact, they have it highlighted in pink so that you see it. According to their research, median CPI does a better job of identifying the underlying trend in inflation than the headline all item CPI or the core CPI, that's excluding food and energy. It even does a better job of forecasting PCE inflation than the Fed's preferred core PCE price index. So that is median CPI. This isn't a later day gimmick. This has been around for a while and gives a good sense of what the underlying trend is in inflation. Right now, the uncomfortable truth for a lot of people is that it remains quite a bit higher than either the headline, which actually ticked up on a year-over-year basis last month, or the core. There wasn't so much concern about the focus on the median CPI when it was lagging. Now that it's higher, people are still ignoring it. I think it's the best indicator for inflation that I've come across. Less volatile tends to give important signals at important turning points. Right now, it's improving in terms of coming down, not nearly the improvement we're seeing from a core perspective or a headline perspective. But the ugly part of this is that as we go through the later part of this year and oil prices, if they remain high, you're going to get an uptick again, probably in the headline inflation number. And people that were talking about it, the big drop in headline data, are now going to switch over to probably the core data, because that could continue to come down even if the headline numbers fueled by higher energy prices start to move higher. I think you cut through that noise, look at the median CPI, and get a better sense of not only where inflation is now, but what the underlying trend is and perhaps what impact that might have on the Fed going forward. So that's what we have in terms of 3 for Thursday this week. Thanks for tuning in. Thanks for listening. Try to do this every week. Go through 3 areas of the market, 3 charts that kind of have captured our attention this week that I think investors should be paying attention to, are paying attention to, or might have overlooked and would benefit from paying attention to. So thanks for tuning in. Thanks for listening. I'll talk to you again next week, everyone.